Welcome, everybody. Today is Friday, June 17th. Doug and I are here to bring you an update on some trading that's happened within our firm. But more importantly, we have always said that if news breaks, we will come to you out of our normal cycle. And so we're basically bringing our June update forward to kind of keep everything up to date. So the first thing I'd like to do is touch on how we got here. The big news, of course, last week was the inflation news, and since then the market's reaction to the Federal Reserve's interest rate increases and so forth. So how did we get here? Well, I think everybody's pretty familiar with the Economics 101 definition of inflation, which is too much money chasing too few goods. And although it's been a slow motion movie and taken quite a while to unfold, if you think back to the real estate crisis of 2007 and 2008, 2009, coming out of that, the Federal Reserve, our Federal Reserve, and really central banks all over the globe made monetary conditions extremely easy to avoid deflationary issues and help get economies back on track. As a consequence, interest rates were brought effectively to zero. Real interest rates, meaning interest rates after one considers inflation, were negative and have been negative for a long, long time. And the central banks made money incredibly available through their balance sheet operations, which is essentially a mechanism whereby they push money out into the world for circulation. So essentially, the world was awash in free money. Well, so that checks box number one, too much money. Then we have to fill in the second part, chasing too few goods. So among other things, we have supply chain issues that followed the COVID crisis. So the world essentially shut down, and the goods production, availability of services all became precious. And following that, we have the Russian-Ukrainian war, and everybody is pretty much aware of the energy and food supplies that come from that region. And so over the course of a couple of years, we've had the supply of goods strangled as well. So you put those two items together in the pot and stir them up, too much money and very relaxed economic policies, along with a meaningful reduction in the supply of goods and services. And we've checked all the boxes for too much money chasing too few goods, a la the really sky-high inflation we see today, inflation rates that we haven't seen for nearly 40 years. So what does that mean for the Federal Reserve? Well, it's important to realize that the Fed has two primary objectives that have been given to them by Congress. The first is help maintain full employment, and the second is help maintain stable prices. Well, fortunately for the Fed right now, the employment market is still very strong. We have very low unemployment, and that provides cover for the Fed to sort of ramp up their inflation fight, because unfortunately the things that they need to do to bring down inflation are going to, in all likelihood, not be good for the economy and probably not be good for employment. So this even came out over the last couple of days in remarks that Chairman Powell made following the Federal Reserve meeting. They pretty much completely acknowledge these are going to be the effects, and seem to be messaging that they're willing to accept even a modest recession in order to get on top of inflation. Inflation is clearly their primary goal at this time. So seeing that this was the likely path, several months ago in February, here at HCM, we reduced our market exposures by selling equities and keeping that money in cash for the last several months, and managing our bond durations as well, because there's two sides of this coin. We always focus on stocks, but bonds make up a meaningful portion of obviously a number of our clients' portfolios. So those were the steps that we took. They have been beneficial, obviously, because we reduced our risk exposure at a time when, for all the reasons listed above, at a time when the markets wound up doing poorly. What's occurred recently, though, is a number of the sentiment indicators that we monitor have gotten to very extreme positions, and when they reach these levels, there is historical precedent for, if nothing else, a relatively short-term rebound from these oversold conditions. And earlier this week, we took steps to recognize that. Still to be determined whether this is a relatively short-term trade in the event that that bounce occurs, or if it's the beginning of a reinvestment process. That will hinge to a large extent on whether or not the central bank's actions do begin to spill over into recession or not. And quite frankly, that's just yet to be determined. But so that's what brings us here today. That's what brings us to the call. So Doug, if you wouldn't mind stepping in and kind of walking us through some of these indicators and
Sure.
the actions that we took here at HCM as a result.
Sure. So as Mike mentioned, we have put cash back to work in the equity side, approximately 5 to 8%, depending on various things in the account were moved from cash to equities this week. Where that money was moved, it was a combination of what I would call a broad market ETF, similar to the S&P 500. Some of our growth positions, as those have been hit extremely hard, and then small cap as well, which again is another area of the market that we feel that has been maybe overly punished with the sell-off that we've seen so far this year. Again, the main driver behind this is the fact that we feel that the market is extremely oversold. And we're going to go through some of the indicators in more detail to show, kind of why we feel that way and how these instances have lined up historically and what returns have looked like going forward from those points. As I mentioned, when these things line up, we see a high probability of positive returns over the next 6 to 12 months from the trade date. And again, this is based on historical indicator evidence going back all the way to 1980. You can see that the average 6-month return is about 11.6%, and the average 12-month return is about 17.3%. Now, again, averages can sometimes be a little bit misleading. This doesn't mean that in every instance this worked out exactly like this, but as Mike mentioned earlier, when we can take money, move it aside in a market that's sold off precipitously, and then add it back in at a level that we think gives us a better opportunity to realize a little bit of a bounce, whether it be a short-term bounce or something more permanent. We obviously want to take advantage of the opportunity. Everyone's heard the adage of buy low, sell high. This is that adage, certainly in practice. And then the last thing I want to emphasize here is this is certainly not a call that this is the bottom. Could it be the bottom? Yes. Are we saying it's the bottom? We're not saying yes. We're not saying no. All we're saying is we recognize that the market is showing significantly oversold readings in many different areas. And we feel like the opportunity is there to add cash back into the risk side of the portfolio and hopefully capture some of that rebound that we would expect to see. So let's get into some of the specific things that we've been paying attention to that has led us to this decision. So one of the readings that we pay attention to is the percentage of stocks in the S&P 500 that are trading above their 200-day moving average. And these red lines here go all the way back to 2000. And this scale here goes from 100, which the market very rarely sees, and goes all the way down to 0. And let me pull my laser pointer out here so it makes this a little bit easier to see. And the current rating that we've got right now, highlighted in yellow, is 13. So we've only got 13% of the stocks in the S&P 500 that are trading above their 200-day moving average. Now, 200-day moving average, why is that number important? Well, it shows a more kind of intermediate moving target for equities. If we did this on a 5 or a 10-day, the volatility would be too much and it probably wouldn't tell us a whole lot. But when we extend it to 200 days, longer trend lines are slower to move, they're harder to break. And when we see breaks, we believe that those are more meaningful. So if you look at this and compare it to some of the other times historically, our target level for this is basically anything under 15%. We're right at 13% now. And if we look back over the past 20, 25 years, and we see other times that these readings have been at extreme levels, it's marked intermediate term bottoms in the market, if not the bottom. So again, going back to 2000, we got under 5%. 2008, you stayed under 5% for a few months, which was actually extremely rare. But then you have 2012, you've got 2016, 2018, 2020, other times when we had pretty precipitous sell-offs. And you can see we touched down below that 15, and usually you see some kind of reflexive bounce back up. So when we saw the percentage of stocks above their 200-day moving average fall under 15, that was kind of one of the criteria that we saw and said, okay, maybe it's time that things are getting a little bit oversold. Now, looking on a little shorter timeline, we also pay attention to the 50-day moving average. So as I mentioned, 200 days, a little bit more of an intermediate term reading. 50 days, a little bit shorter. Now, with this one, under 5% is what we want to see here. So right now, we've got the percentage of stocks trading above their 50-day moving average at 1.8%. So again, we line that up with other historical times where we've seen either market bottoms or intermediate market bottoms in maybe a larger drawdown. And again, this lines up very well with this. So 2000, you had it actually close to zero. 2008, under 1%. 2012, under 1%. 2018, 19, you had it about 1.25. And then during COVID, a similar time. So again, the percentage of stocks above the 50-day moving average at this extreme of a level is telling us, along with the 200-day, that both on an intermediate term basis and on a shorter term basis, we're seeing a lot of oversold conditions present in the market. Now, to put some more numbers behind this specific indicator, this is a chart that goes back to 2000 and shows the 30 instances where the percentage of stocks above the 50-day moving average was at its lowest point. So the lowest reading we got was in 2002 at 0.2%. So basically nothing was above the 50-day moving average. Then the highest reading in this lowest reading chart was in 2008, where we got 2.4. So at the time that this chart was created, was 2 days ago, we were right around 2% on this reading. Now, we look at the forward returns on the S&P 500. Now, you look 1, 3, 6, 9 months out, there's a lot of green here, but there's also a lot of red. And in some instances, the red numbers are double digits. But the important thing I think to focus on is if you look 1 year and 2 years out from those instances, 100% of the time, and again, I'm not implying this is a guarantee, but 100% of these readings are green. And in some instances, they're extremely green. You've got several returns here that are over 20%. You've got some that, 50, 75, 85, 100% even. Now, I can't emphasize enough. We're not saying that you're going to see 100% returns over the next year or two. All we're saying is that based on these statistics, these very objective data points, that when you see markets get oversold to this level, the forward returns 6 to 12 months out have a higher probability of being positive than just at any random time in the marketplace. Lastly, one indicator that we pay close attention to as well is called the Williams R, and we set this on a weekly reading. So what Williams R does is it takes the weekly reading for the asset class that you're measuring. So in this case, this is the S&P 500. and it takes the highest reading that it's had in the past 52 weeks, and it takes the lowest reading that it has in the past 52 weeks. And that kind of describes the range that we're looking at. And then the current reading is kind of the score level based on that range. So if the market was trading at its highest weekly point of the past 52 weeks, that score would be close to 0. I know it's kind of counterintuitive the way they score this, but 0 means a very high number. And if it's trading at the bottom end of that 52-week range, it would be close to -100. So in this case, we've had this number fall all the way to -102.71. Now, some people may be asking, how can you go under 100? Well, if the weekly reading that you've got in your range is now broken by the current weekly reading, that is how you get a score below 100. But again, referencing other points, here we have the S&P up here, but if you look at some of the other market bottoms that we've had over the past 5 years, 2018, you can see this is shaded in blue, close to -100. Again, during COVID, close to -100, and now we've broken through that to get to -102. So we never look at any of these individually and say, hey, this is enough to make this decision. But if we take them on a cumulative basis, and we have several that are giving us indications that the market is very oversold, that is a time where we want to go ahead and use that opportunity to take action and add risk back. Now, some other ones that maybe not, that aren't on our radar as much, but that we've come across. So here's the Bank of America bull bear indicator. It basically just shows kind of a sentiment reading about how many people are bullish versus how many people are bearish. The current reading is 0, which is about as bearish as you can get from a sentiment indicator. These don't go below 0 so from a contrarian standpoint, they're looking at this and saying, this could be a buying opportunity and something you might want to take advantage of. And then, as we talk about all this, I think it's good to take a step back and see where exactly, what has exactly happened since the beginning of the year. So this shows the drawdowns for the S&P 500, the Russell 2000 in purple, which denotes small caps, and then the Invesco Triple Q ETF, which is a NASDAQ-based investment product. So that is in blue. So we can see here the drawdowns from all-time highs in the S&P has now breached that quote unquote bear market level of 20% with a 22% drawdown. But in small cap and growth, the number's been even higher. It's been 30% for small caps and 32.5% for the triple Qs. Now, these are big numbers. And if we talk about, we spending a lot of time talking about bear markets recently, and we've seen a lot of news about bear markets. But over the past 140 years, we've only had 20 bear markets. So it's an average of about 1 every 7 years. But they're maybe not as common as people would lead on to believe. And when you start getting numbers that are this big in terms of drawdowns, I think people start to think that the worst case scenarios start to creep into their mind. And at the same time, you believe that it's just a straight line down. But even the worst bear markets in history have not been straight lines down, with maybe the exception of 1987, which is a one-day event. But within that time frame, there are counter trend rallies, and sometimes those can be very strong. And our expectation is that we've got a pretty good chance of seeing something like that over the short term with some of the readings that we've seen. And we can see, even with the drawdowns this year, you've had these big spikes, specifically at the end of March, where this rally was about, I believe it was 10-13% here, and then another one that barely reached 10% here. So it's not out of the question to certainly see another one. And for some of our clients who are regular readers of the Market Insight, we sent that out around this date right here. And I think at the end of it, we mentioned that there would be a time to kind of add risk back into portfolios along to the equity side, but that day wasn't today. Well, since that hit the wire, we've seen another 10% sell off from that point. So even in bear markets, things can move very quickly, both to the up and to the downside. Now, a lot of what we've talked about so far has been sentiment and more technical indicators. But when we think about fair value and fundamentals, what do we think that looks like in terms of gauging where the market should end up, so to speak? And in our investment committee meetings and subsequently, we've started to have this conversation a little bit more intensely, trying to gauge what we think fair value of the market might be here. And as we have this chart, what it shows is on the top line, we've got what the earnings of the S&P 500 might be going forward. 2021 earnings came in right around $208. So that's the level right here. Expectations for this year are for 10% growth, which would take us to 229. But we've also got some numbers below that. And Mike's going to talk a little bit about how we think you get a number below here. But then also you have the market multiple that goes into that. The 5-year average market multiple is right around 19. The 10-year average is about 17. What I forgot to put on here was the current market PE right now on a forward basis is right around 16.5. So we can probably put it between 17 and 16 here. But again, these are moving targets because the multiples have come down quite a bit since the beginning of the year, where we were seeing multiples, in the low and mid 20s. It's been a pretty big reduction in those multiples. So, Mike, as we look forward, and you certainly mentioned a lot of things at the beginning of the call. What do you think a fair expectation for earnings this year might be?
So I guess that's the $1 million question. The challenge here is, are we going to be tipped into recession or not? In the typical recession, earnings fall about 20%. So as Doug mentioned, earnings last year 208. Right now, analysts coming into, of course, every quarter we get the numbers are examined and reviewed and revised. It's my expectation and our expectation that is when we get quarterly announcements at the end of June, that companies will begin to play it safe with their estimates. There's pretty much all of the recent economic indicators that have been released in the last week or so are beginning to show slowing. Doug may be able to speak to that, but they're coming from all sorts of different directions. Everybody knows what's happened with mortgage rates. The Lone Ranger that's still hanging out there is employment, but even that's starting to show some chinks in the armor. In any event, if the calculation of a PE multiple or the calculation of the stock price using a PE multiple is pretty simple. You simply take the P times the E. So the earnings times the multiple to get to the price. So if earnings are magically dropped by $20, $30, $40 per share, then and we simply do the arithmetic, we're looking at a 20, 30, 40% decline in fair value from the established multiple. Now, unfortunately, all these are moving targets. The way we think about it internally is slightly different, but it gets you to the same place. If you think about a risk-free rate of return, which is sort of what the Federal Reserve is trying to establish now, in the past, the risk-free rate of return has been near zero because that's what was being charged for risk-free, for government guaranteed money, risk-free money. On top of that, if you think of the building blocks, then there's a risk premium. So what would a rational investor demand as a probable return in order to take the risk of investing? There's a lot of unknowns in the future. If everything was rock solid, we were in a super growth mode and was clear sailing for years to come, they would demand a smaller premium in order to put their capital at risk. If there are a lot of questions, like, for example, are we going into recession? What's going to be the outcome of war? How far will the Fed have to hike interest rates and so forth? Then people will demand a higher premium in order to risk their money. When you add both those numbers together, you get a capitalization rate, not to get too far inside baseball, but it works kind of the same way as these multiples. And the higher the number, the lower the fair value. So the guesswork here is, where are those things trending? Well, it doesn't appear at this point that they're trending in a favorable level. That's part of what's brought us to this trade that we're describing today, because sentiment has recognized this and pushed things, as Doug's already pointed out, to almost historic lows by these certain measures, almost to the point where it's so bad that it's good. Could this be a stepping stone with progressive lower highs and lower lows? That's a very real possibility. And so coming back to this chart, if earnings wind up being, let's say they just don't go up this year, they stay at 208. And as Doug has pointed out, we're already at 16 and a half forward multiples. Let's just call that a 16 to keep the numbers round. Well, that gives us, if that was where we settled, then fair value would be 33.28. We look at fair value, or our estimate of fair value, as an anchor. The reality is prices pass through fair value on the way up and the way down based on sentiment. So if investors become pessimistic, they drive prices below fair value, and that's what creates the opportunity, as Doug sort of spoofily mentioned earlier, to buy low and sell high. I mean, that's what Mama always told us to do. And so the idea is, how do you identify when things are low? Well, you want to find them being sold for below fair value. What we know when we talk about being a long-term investor is that when we get outside of the emotional cycles, these multiples tend to hover, what would you say, Doug, around between 17 and 18 and
yeah, if we,
times?
yeah, I mean, if we look at the, just to use the example that you had here, 208 is no growth. 5-year average is 19, 10 years 17. We'll call it 18 to split the difference. You're looking at 37.44, which is actually a level that, depending on where we're trading right at this moment, is probably right at fair value, or that we're trading a little bit below fair value right now.
So as a long-term investor who believes in capitalism and compounding, there's no problem with buying at fair value. Might you see emotions take over and prices go lower? Absolutely. But you're not making a mistake. You will get organized, fair returns going forward. And of course, here at HCM, we are basically building those type of return expectations into our retirement calculations when we're focused on what people can expect to earn over time. So that's why targeting a fair value number is so important. If we should slip into recession for a period of time, fair value may go even lower, driving prices lower. But again, that's where the opportunities present themselves. And I think we'll get into that possibly in the next slide as to what may happen next. But
yeah, so let's go to that slide. I mean, basically asking the question, what are the data points that matter the most? What are the things that are going to, I guess, adjust those, those ratios, both on the earnings side and on the multiple side. So, as we run down through these, so the first thing that Mike had mentioned was recession. So, we've had some recent data points that's kind of led to the conclusion that we've got an increased probability of a recession coming. The question now becomes, is it a shallow recession or is it a deep recession? Because, from a market standpoint, the markets, and if you've heard me talk about this before, you might be, quietly calling me out here, because the term priced in is one of my least favorite terms in all of finance. but I'm going to use it now. The market has priced in a lot of bad news, almost awful news, so to speak. And we use the phrase that you can make the most money when the news goes from awful to really bad, as opposed from bad to good. So, in terms of recession, has the market priced in a shallow recession, or has it priced in a really deep recession? Probably, right now, in between those two things. You had the Atlanta Fed, which does kind of a real-time GDP estimate, revised their next quarter GDP reading to 0. And if you remember, last quarter we had a negative GDP print. So technically, by Economics 101, if we get another negative GDP number, that will officially put us into a recession. But the market usually doesn't wait for that call. It's going to operate ahead of time, and it's repriced itself to reflect the possibility of a recession. So, what would the bad situation there be? If employment really started, a deep recession, obviously. But if we were able to get a shallow recession with inflation coming down, it could be the catalyst for a turnaround, so to speak. The next item obviously is rates.
Well, before we leave that subject, I just want to say that examining Jerome Powell's comments after this week's meeting, my conclusion is that they are now acknowledging and probably targeting a mild recession. One of their biggest fears, obviously, their biggest fear would be deflation. We're not focused on that at all, but a stagflationary environment similar to something we had in the 70s would be their real boogeyman at this stage of the game. And that's one of the reasons it's so important for them to get the inflation rate down quickly, as funny as this sounds, so that they have the ability to relax policy and keep us from getting even further into that. So we haven't sort of officially changed our base case scenarios yet, because this is all very new data. We'll be collecting information over the weekend, but it appears that a mild recession is sort of the new base case scenario. And then the big question is, can the Fed be that precise? And that's a big discussion these days.
Yeah, and that ties into the next point with rates. So the Fed has gone from not even thinking about raising rates to increasing 0.75% in a single meeting. That is a
Doug, how many weeks has it been since Powell said this wasn't even on his mind?
I don't know the exact number, but it hasn't been that long. I think it's been inside of a year.
I think it's been inside of the last month or month and a half that he said 75 basis points was not even being considered. Yeah, that's what they did.
Okay, yeah, I'm sorry. I thought you were referencing the not thinking about raising rates.
Oh, no.
Because I think that commentary has been within the last 12 months, and then yes, I believe it was either the last meeting or the meeting before where 75 basis points in their eyes wasn't even on the table, which in some ways shows the folly of the Fed and the fact that they've now they've relied for so long on this idea of forward guidance and giving the market some semblance of what could happen in the future, that they've kind of boxed themselves in at times, committing to doing this or not doing this, where I think they say often that they're data dependent. I think that should be enough in most cases to guide their policy. So what we've seen, that the bond market's already done a lot of the Fed's job for them. The 2-year yield has gone basically vertical, was trading at, I think, 0.16% 6 months ago, and has moved all the way up to, I believe, 3.2 or 3.3%, which, I mean, that's a historically fast move. So the 2-year yield operates much on Fed expectations, but then the 10-year yield has also moved up as well. But the 10-year yield operates more off of economic growth expectations. So when we say, has the market gone too far here? The 2-year yield is, they're expecting the Fed to follow through with their rate hikes. Now, what I would say is, kind of on the other side of this, the Fed said inflation was transitory probably 6 or 7 months ago. And now they're guiding to a neutral rate of 3 to 4%. So I think a lot of people who are maybe concerned that that's going to be the ultimate outcome, don't forget how wrong they were on the front end of this. There's a possibility that they don't even get there. But even if they don't, the bond market has already kind of done that legwork for them on the front end. But one thing that we've talked about a lot in fixed income is that if recession and slow growth start to become a reality, and it looks like from everything that we can see that it will be, longer term yields might actually start to come down a little bit as they begin to price in that recession. Now, there's also the supply that's coming online with quantitative tightening. And if inflation, continues to be a problem, it might offset some of that. But that, I think, is something that maybe is a little bit overlooked in all this when we talk about bonds and what the future might hold for fixed income. So the good news is, clients who are looking for income as they're getting ready to start or in retirement, those rates have gone up, so those income levels will certainly follow. I mean, the idea that a year ago you would never even consider buying a 2-year Treasury bond because it didn't pay you anything, to now getting over 3% is a pretty big jump in income. Employment is going to be the stat that I think will be most determinant on whether or not we have a bad recession or a shallow recession or a non-recession, I guess, because most recessions do lead to job losses, and that's going to pull money out of the economy. The consumer continues to be the driver of economic growth, and if they don't have money to spend, they don't have money coming in from jobs, then that consumer spending is obviously going to come down. We are right now at historic levels of unemployment in terms of the unemployment rate. So can that number stay low, and is the economy going to continue to have, put people to work essentially if there's concerns about a slowing economy? Mike talked about earnings earlier. So historically, he mentioned that, recession have seen earnings drop by 20 to 25%, which is a pretty big number, especially when you look at that and you say, okay, current estimates for 2022 are for 10% growth. So even if we chop that 10% growth out of the equation and took it down another 10%, the fair value numbers could certainly be a lot lower than what we're seeing right now. So earnings estimates revisions are going to start to hit the tape in earnest here in the near future. So it'll be very interesting to see how those look if you're getting companies that are guiding down and what that will do again to change that fair value equation. And then lastly, inflation. I feel like we've been talking about it now for the better part of 6 months, but expectations are still very high for inflation. I mean, several more months of 8+% inflation has been priced into the market. But one of the questions that we want to pose to people, because I think we've delivered a lot of what I'd say sobering news in this, is that what if that number is too high? What if inflation does start to come down almost unexpectedly? We're not saying that it will, but if it could, that really changes the calculus on a lot of things. It gives the Fed more room to possibly not get to 3 to 4%. It may free corporations up from cost pressures. It's certainly going to free the consumer up from cost pressures. It just opens up a lot of avenues where I think a lot of people are looking at the worst case scenarios. That's one that I think could maybe catch people by surprise and maybe lead to some positive things happening down the road. But for the near term, inflation remains a problem. The Fed says they remain committed to bringing it down with the tools that they have. If it's going to continue to be a supply issue, unfortunately, they can't They can't print more wheat. They can't print more gas. They can't print more oil. So they're going to do what they can, but I think there's other aspects of the inflation picture that probably need to resolve themselves, as well as the Fed raising rates to fight that. So, from our perspective, these are the main data points and the things internally that we're going to be paying attention to very closely over the next few months to try and figure out, what is fair value going forward and kind of how that will affect our trading activity going forward. Mike, do you have anything that you want to add to these points before we wrap this up?
The only thing, I guess, from a portfolio perspective, we certainly have a variety of possible outcomes in front of us, just so people understand, what that looks like. What we've laid out here is a portfolio adjustment directly related to a very short-term and very extreme oversold condition that's been created by people panicking in the market. The likelihood, the expectation that we have based on historical observations is that we'll see a bounce off of those levels sometime, usually starts within a week or so, and it can be very short term, may last for several weeks. At that point, we'll have to evaluate whether or not it's best to handle that as a trade or leave that money invested. It's also, I want people to know that if the market did sell off hard from here and got to those sort of historical places, we still have more dry powder left to deploy to take advantage of even lower prices should they present themselves. Otherwise, a lot of the portfolio is managed through asset allocation. It's not just am I holding cash or am I invested in stocks, but how that's allocated, and that's also a regular ongoing observation for us.
Right.
The other positive from a retirement planning perspective, as Doug pointed out, is the yield is there. One of the things, of course, that is the anchor around our practice and has been for 30 years is the focus on growing income through dividends. Fortunately for us, those are the types of stocks that make up the core of our portfolio. Those are the types of stocks that have been doing the best during this period of time. So, and on top of that, it creates regular cash flow in the portfolio, even when the market's doing crazy things. So I think those are all things to be aware of as well.
Great. All right. Well, I think that's it, Mike. If you want to take us out.
Yeah. Otherwise, again, this sort of takes the place of this month's call that would normally happen in a week or so. What we're planning on then is going back to our regular schedule in July, which tentatively is the third week of the month. Of course, we are always here and will come to you if news breaks or if we do wind up making any out of the ordinary portfolio adjustments. Other than that, hope everybody enjoys their summer. Hope it gets cooler here anyway.
Thanks.
Thanks, everybody. Bye-bye.